A stock turns irresistibly hot when the perfect storm of momentum, volume, and market conviction builds pressure just right. It starts with a fresh catalyst that draws institutional money flowing in deep, swelling buy-side interest until shares thrust upward with real force. Volume spikes on the breakout confirm the move is genuine, not just a tease. Technical indicators set the stage first as price rides up to key resistance levels before penetrating them with conviction, while RSI climbs into overbought territory where the real heat intensifies. Fundamentals add fuel through accelerating earnings, expanding margins, or powerful sector tailwinds that leave investors breathless. When retail enthusiasm joins and short interest creates a squeeze, the stock moves beyond teasing into explosive gains. The hottest names do not simply rise. They throb with potential until the upward release feels inevitable. Some of the hottest stocks in market history became scorching because the crowd finally recognized the buildup that had been forming beneath the surface. Tesla rode the electric vehicle revolution with strong conviction as production ramps and battery breakthroughs pushed the share price higher on consistent delivery beats quarter after quarter. Institutional money poured in deep, while the narrative kept momentum pulsing higher and higher. NVIDIA captured the same intensity during the AI boom, as demand for chips exploded and earnings repeatedly surprised to the upside. The stock rode powerful upward legs into triple-digit gains as data center spending deepened far beyond expectations. Amazon, in its early growth phase, created a similar effect through e-commerce dominance that built an ever-widening moat. Once the market grasped the scale, shares broke out and compounded returns that rewarded early believers handsomely. What made these stocks truly hot was perfect timing combined with undeniable growth catalysts, innovation that created scarcity, and sentiment that built pressure until the breakout became unstoppable. History repeats the pattern: quiet accumulation followed by sudden, powerful momentum. To catch the next hot stock before everyone else feels the heat, watch for specific signals while the setup is still coiling tight. Price action should tease a major moving average crossover, especially the golden cross between the 50-day and 200-day lines that signals a serious uptrend is forming. Volume provides the clearest confirmation as it swells on up days and dries up on pullbacks, showing smart money is already positioned. RSI rising above 60 with room left to run, along with MACD lines crossing upward, mark the early pulses of building strength. On the fundamental side, seek accelerating revenue growth, margin expansion, and a clear upcoming catalyst, such as a major product launch or favorable regulatory shift. Rising institutional ownership week after week and short interest above 10% raise the chance of a powerful squeeze. Sector rotation adds another layer as capital flows into previously overlooked groups and leading names show strong relative strength. Patience and close observation are essential so that when the conditions align perfectly, the opportunity to enter becomes obvious. The greatest benefit of hot stocks comes from the way they reward investors who enter at the right moment and ride the full wave of upside. Once momentum takes hold, capital compounds rapidly through sustained price appreciation, as each earnings beat drives shares higher. Returns on investment accelerate as the valuation multiple expands with swelling sentiment, often delivering double-digit or triple-digit gains while the broader market moves sideways. Any dividends serve as additional reward on an already strong move, but the primary climax arrives through capital gains that can be realized or reinvested into the next opportunity. Proper position sizing and disciplined stop losses protect against downside while allowing participation in the complete run. Hot stocks demonstrate a core market principle: entering when pressure is building, holding through natural volatility, and exiting only when momentum begins to ease leads to consistent outperformance. Applied repeatedly, this approach turns returns into powerful compounding growth that makes ordinary investments feel far less satisfying by comparison. Some of the hottest stocks in market history became scorching because the crowd finally recognized the buildup that had been forming beneath the surface for an extended period. Tesla rode the electric vehicle revolution with strong conviction as production ramps and battery breakthroughs pushed the share price higher on consistent delivery beats quarter after quarter. The company transformed from a niche automaker into a technology powerhouse by scaling manufacturing at a pace few thought possible, with each earnings report revealing higher margins and expanding global reach that sent institutional money pouring in deep. The narrative around sustainable energy and autonomous driving kept momentum pulsing higher and higher, creating a self-reinforcing cycle where every positive development added to the upward pressure. Volume would surge on news of new factory openings or regulatory approvals, confirming that the interest was broad and sustained rather than fleeting. Technical breakouts occurred repeatedly as the stock penetrated resistance levels that once seemed insurmountable, with RSI readings climbing into overbought territory only to reset during healthy pullbacks before thrusting higher again. This combination of real business progress and market sentiment created the kind of heat that turned Tesla into one of the most watched and rewarding investments of the past decade, delivering returns that compounded dramatically for those who held through the volatility. NVIDIA captured the same intensity during the artificial intelligence boom as demand for advanced chips exploded and earnings repeatedly surprised to the upside. The company had been quietly building expertise in graphics processing units for years, but the sudden surge in AI applications created a catalyst that made the stock feel irresistibly hot almost overnight. Data center spending poured in deeper than anticipated, with hyperscale customers committing to massive orders that expanded margins and revenue at rates that left analysts breathless. The share price rode powerful upward legs into triple-digit gains as each quarterly report reinforced the narrative of insatiable demand. Volume spikes accompanied every major announcement, showing institutional conviction that refused to fade even during temporary pullbacks. Technical charts showed the price hugging moving averages before breaking out with conviction, while short interest created additional squeeze pressure that amplified the moves. NVIDIA exemplified how a secular trend combined with execution excellence can turn a stock into a market leader that throbs with potential for years, rewarding early believers with returns that far outpaced the broader indices. Amazon, in its early growth phase, created a similar effect through e-commerce dominance that built an ever-widening moat around its business. The company started as an online bookstore, but expanded relentlessly into general retail, cloud computing, and logistics, each new segment adding layers of revenue and profitability that the market eventually recognized with increasing enthusiasm. Once investors grasped the scale of the opportunity and the competitive advantages Amazon had constructed, shares broke out decisively and began a long period of compounding returns. Institutional ownership swelled as funds slid into deep positions, volume expanded on positive news flow, and the stock demonstrated long, strong legs by recovering from every dip with renewed vigor. Earnings growth accelerated as the AWS cloud division became a profit engine, creating fundamental support that justified ever higher valuations. The narrative of Amazon as the everything store combined with tangible business metrics to produce the kind of sustained heat that turned patient investors into significant wealth over time. What made these stocks truly hot was perfect timing combined with undeniable growth catalysts, innovation that created scarcity, and sentiment that built pressure until the breakout became unstoppable. History repeats the pattern across many names. Quiet accumulation by sophisticated investors, followed by sudden, powerful momentum once the catalyst arrives. Apple, during the smartphone era, followed a comparable trajectory as the iPhone redefined consumer technology and created an ecosystem that generated recurring revenue through services and accessories. The stock built pressure for years as margins expanded and global adoption accelerated, eventually thrusting higher on technical breakouts that coincided with record earnings. Volume would surge on product launch days, confirming broad participation, while short squeezes added extra thrust during key periods. Netflix transformed the entertainment industry by pioneering streaming, building a subscriber base that grew exponentially and created a content moat that competitors struggled to penetrate. Each earnings beat sent the shares pulsing higher, with institutional money flowing in deep as the market recognized the shift from linear television to on-demand viewing. The pattern is consistent. A visionary idea meets execution, fundamentals improve dramatically, technicals confirm the move, and sentiment turns euphoric, creating the throbbing advance that defines hot stocks. Other examples reinforce the lesson. During the dot-com era, companies like Cisco Systems rode the internet infrastructure boom with similar dynamics, as demand for networking equipment exploded and the stock delivered extraordinary gains before the eventual correction. More recently, certain biotechnology names have become scorching on the back of breakthrough drug approvals, where a single positive clinical trial result can create explosive volume and price action that rewards those positioned ahead of the news. The common thread across all these cases is the alignment of innovation, execution, and market recognition after a period of underappreciated buildup. Quiet accumulation gives way to public enthusiasm, volume confirms the shift, technical breakouts provide entry signals, and fundamentals justify the higher valuations. Short interest often plays a supporting role by creating squeeze conditions that accelerate the upward release. Investors who study these historical cases learn to look for the same ingredients in current names: a compelling long-term story, improving financial metrics, institutional accumulation, and technical setups that show pressure building rather than dissipating. The market environment also influences how hot a stock can become. In periods of easy liquidity and low interest rates, growth names tend to heat up more readily because capital flows freely toward future potential rather than current yield. Bull markets amplify the effect by creating a rising tide that lifts innovative companies higher and faster. Conversely, in risk-off environments, the hottest stocks may take longer to develop their momentum, but once the catalyst hits, they can still deliver powerful relative performance. Understanding these macro influences helps place individual stock moves in context without diminishing the importance of company-specific factors. Across decades, the pattern holds. The stocks that become legends do so by building pressure beneath the surface until the market can no longer ignore the heat. Tesla, NVIDIA, Amazon, Apple, and countless others demonstrate that when timing, innovation, execution, and sentiment align, the result is a sustained advance that feels magnetic and rewarding. History provides the blueprint, showing that the hottest stocks are not accidents, but the natural outcome of forces that investors can learn to recognize and position for ahead of time. To catch the next hot stock before everyone else feels the heat, watch for specific signals while the setup is still coiling tight. Price action should tease a major moving average crossover, especially the golden cross between the 50-day and 200-day lines that signals a serious uptrend is forming with conviction. This crossover does not happen instantly. It develops over weeks as the shorter-term average climbs above the longer-term one, creating a visual confirmation that momentum is shifting in a sustainable way. Volume provides the clearest confirmation as it swells noticeably on up days and contracts on pullbacks, revealing that smart money is already accumulating positions without drawing too much attention. A stock showing higher volume on advances than on declines demonstrates underlying strength that can support further upward pressure. Momentum indicators add important clarity when the relative strength index moves above 60 with room left to run, indicating that buying interest is gaining steam without yet reaching extreme levels that might signal exhaustion. The moving average convergence divergence, or MACD lines, crossing upward with the histogram expanding positively, mark the early pulses of building strength that often precede the wider market's awareness. On the fundamental side, seek accelerating revenue growth, margin expansion, and a clear upcoming catalyst such as a major product launch or favorable regulatory development. Revenue growth that moves from 10% to 25% or higher year over year shows the business is hitting an inflection point where demand is outpacing supply, creating the scarcity that makes investors take notice. Margin expansion, whether through cost efficiencies, pricing power, or scale advantages, translates directly into higher earnings per share and justifies premium valuations. The catalyst acts as the spark that ignites the move, whether it is an earnings report scheduled to exceed consensus estimates, a new contract win, or a change in government policy that benefits the sector. Rising institutional ownership tracked week after week through filings provides further evidence that large funds are sliding into deep positions, adding credibility and buying power that can sustain the advance. Short interest above 10% of the float raises the possibility of a powerful squeeze, where any positive price movement forces covering that adds mechanical upward thrust. Sector rotation adds another layer as capital flows into previously overlooked groups, and leading names within that group show strong relative strength. When money begins leaving defensive sectors like utilities or consumer staples and rotates into technology or industrials, the strongest names in the new hot sector often begin to pulse ahead of the pack. Relative strength charts comparing the stock to its industry index or the broader market help identify these leaders early. The key throughout is patience and close observation, so that when the technical and fundamental setup aligns perfectly, the opportunity to enter before the real thrust begins becomes obvious. Charts should show a series of higher lows, forming a clear uptrend channel, with price respecting support levels on pullbacks before resuming the advance. Candlestick patterns such as bullish engulfing formations or hammer candles at support can provide additional confirmation that buying pressure is returning with force. Beyond the core indicators, consider the broader market context and the stock's liquidity profile. A name with sufficient average daily volume, ideally several million shares, allows for easier entry and exit without moving the price excessively. Low float stocks can become hotter faster due to supply constraints, but they also carry higher volatility that requires careful position sizing. News flow should be monitored for positive developments that reinforce the narrative without appearing overly promotional. Earnings revisions upward by multiple analysts create a positive feedback loop that keeps sentiment swelling. Insider buying, when reported in regulatory filings, can serve as a powerful signal that those closest to the business see value at current levels and are willing to commit personal capital. These signals rarely appear in isolation. The strongest setups feature several of them converging at the same time, creating the kind of coiled tension that precedes a significant breakout. Risk management remains essential even when the setup looks compelling. Stop-loss levels placed below recent swing lows or key moving averages help protect capital if the anticipated thrust fails to materialize. Position sizing should reflect the conviction level and the overall portfolio risk, ensuring that no single name can create outsized damage if the market environment shifts unexpectedly. Diversification across several potential hot stocks, rather than concentrating in one, reduces the impact of any individual disappointment while still allowing participation in the broader theme. Monitoring the stock after entry is equally important, watching for continued volume support, sustained RSI strength, and ongoing fundamental progress that validates the original thesis. If the price begins to break below key support on increasing volume, it may signal that the heat is dissipating and a more defensive stance is warranted. The process of identifying hot stocks is part art and part science, requiring both quantitative analysis and an intuitive feel for market rhythm. It involves scanning hundreds of charts and financial reports to find the handful that exhibit the complete combination of factors. Screening tools can help narrow the universe by filtering for stocks with RSI above 60, volume above average, and earnings growth exceeding 20%. Yet the final decision often comes down to the qualitative judgment that the narrative feels compelling and the technical picture shows genuine building pressure rather than random noise. Over time, investors who consistently apply this disciplined approach develop a sense for when a stock is about to turn irresistibly hot, allowing them to position early and benefit from the full duration of the upward move. The market continually presents new opportunities, and those prepared to recognize the early signals gain a significant edge over those who wait for obvious confirmation after the easiest gains have already occurred. The greatest benefit of hot stocks comes from the way they reward investors who enter at the right moment and ride the full wave of upside. Once momentum takes hold, capital compounds rapidly through sustained price appreciation as each earnings beat drives shares higher with conviction. The return on investment accelerates dramatically as the valuation multiple expands with swelling sentiment, often delivering double-digit or triple-digit gains while the broader market moves sideways or even declines modestly. A stock purchased at the early stages of its hot phase can see its value multiply several times over as the market recognizes the growth story and bids the price up accordingly. This compounding effect turns modest initial positions into substantial portfolio contributions, creating wealth that can fund future opportunities or provide financial independence. The process feels powerful because the gains are driven by both business performance and market enthusiasm, creating a self-reinforcing cycle that sustains the advance over months or years. Any dividends that accompany the price appreciation serve as additional reward on an already strong move, though the primary climax arrives through capital gains that can be realized or reinvested into the next promising opportunity. Reinvesting gains from one hot stock into another allows the portfolio to maintain exposure to high momentum names, keeping capital working in the hottest areas of the market rather than sitting idle. Proper position sizing ensures that the investor remains comfortable through normal volatility while still capturing meaningful upside. Disciplined use of stop losses protects against downside during periods when the upward pressure temporarily eases, allowing the position to be exited gracefully if the thesis changes while preserving most of the accumulated gains. This risk management approach keeps the investor engaged for the complete run without exposing the portfolio to catastrophic losses that could derail long-term progress. Hot stocks demonstrate a core market principle clearly: entering when upward pressure is building, holding through natural fluctuations, and exiting thoughtfully when momentum begins to ease leads to consistent outperformance. The fluctuations themselves often provide opportunities to add to the position at better levels, or simply reinforce conviction as the stock respects support and resumes its advance. Over time, applying this strategy repeatedly across multiple hot names creates a portfolio that grows faster than one constructed from slower-moving, lower-conviction holdings. The psychological benefit is equally significant because participating in a hot stock generates confidence and excitement that encourages continued disciplined investing rather than emotional reactions to market noise. Investors learn to trust the process, recognizing that the throbbing upward energy is backed by tangible fundamentals and technical confirmation rather than pure speculation. The tax implications of hot stock gains should be considered as part of the overall strategy, with long-term holding periods potentially qualifying for more favorable capital gains rates that enhance net returns. In taxable accounts, this encourages a longer horizon that aligns well with the sustained nature of the hottest moves. In tax-advantaged accounts, such as IRAs or 401ks, the full power of compounding can be harnessed without immediate tax drag, allowing gains to build upon gains more efficiently. Portfolio rebalancing periodically ensures that exposure to hot stocks remains appropriate relative to overall risk tolerance and investment goals, preventing any single name from dominating the allocation even as it performs exceptionally well. This disciplined approach maintains balance while still allowing the investor to benefit fully from the opportunities presented by high-momentum names. Beyond individual stock performance, hot stocks contribute to broader portfolio health by providing diversification through exposure to innovative sectors and growth themes that may be underrepresented in traditional index holdings. When the market favors growth over value or technology over energy, these names can act as a powerful offset to lagging areas, smoothing overall returns and reducing drawdowns during certain market regimes. The experience of riding a hot stock also sharpens analytical skills, teaching investors to read charts more effectively, interpret earnings reports with greater insight, and understand the interplay between technicals and fundamentals. This education compounds over time, making subsequent opportunities easier to identify and evaluate with confidence. The market continually offers new hot stocks as economic conditions evolve, technological breakthroughs occur, and consumer preferences shift, ensuring that patient and observant investors have a steady supply of potential opportunities. Ultimately, the greatest benefit lies in the transformation of capital from static holdings into dynamic, high-growth assets that deliver returns capable of changing financial trajectories. A portfolio that consistently captures a portion of these hot moves experiences compounding growth that far exceeds what is possible through average market returns alone. The satisfaction of seeing an investment thesis play out successfully, with the share price thrusting higher on confirming data and market enthusiasm, reinforces sound decision-making and encourages continued engagement with the markets. Hot stocks turn investing from a passive exercise into an active pursuit of opportunity, where knowledge, timing, and discipline combine to produce results that feel both intellectually stimulating and financially rewarding. Applied with consistency and proper risk controls, this approach leads to portfolio growth that makes ordinary investments pale in comparison, creating the kind of long-term wealth accumulation that defines successful investing.